6 ways to trade the news and 3 ways to avoid it. Is the mic okay? Because I'll get going.
Yeah.
Yep, you're good.
Sounds good.
All right. Okay. The reason I started doing all this is I realized early on, every single time that I got shut out, it was always right around the news and a marching market continuation that just marched for hours and hours and hours. And that was it. And I got 5 down. So my first goal, it wasn't to trade the news, but it was to avoid it and to avoid outside ranges. And that is exactly the reason for the title. So if you want to know how to do it, I'll show you how to do it. And if you don't know how to avoid it, I'll show you how to avoid it. So if the market moves, if it moves 50 or 80 or 100 pips instantaneously, or in less than a couple of hours, then that's because everyone in the world, everyone in the financial world is paying attention to that same spark of news. It's called a catalyst of news because it's something that sparks a reaction. And if it moves that quickly and that decisively, then it must mean that it has multiple billions of dollars behind it, all pushing in the same fundamental direction. And it essentially means that all of the institutions of the world are reacting in unison, and they're reacting with a plan. And if there's a plan to it, then there must be a pattern to it. And I thought, can we find this pattern? And the answer is yes, we can. In fact, I'll give you a hint. This is one of the first ways that quant funds will approach it, is they search for all possible correlations that they can find, and then they test them to see, do they have predictive power? And if so, are they real? Are they reliable? And if so, are they tradable? And are they profitable? And that is where it begins. Institutions, they're what moves the market. And it starts with central banks. They're the people who make the decisions from the top. And all institutions, central banks, all funds, they're all required to have their own internal fundamental models that give them forward guidance. And they're all required by their mandates to have a set method, and they're required to follow it. So they're required to have a plan, and they're required to stick to it, and they're required to sort of move sort of on rails a lot of times. And that's exactly why it's, in a lot of cases, impossible to find out what they're planning to do, what they will do, and how institutions will react to that. And this is, this is the FOMC, actually. This is who they are, down in Washington, D.C. This is the European Central Bank. It's the same thing, but for the euro. Do more of a round table kind of format, if you can see that. Then that's the Bank of England, Bank of Japan. So when the central banks or governments in general, when they put out reports, the financial world hears that and they react in ways that are a lot more predictable than you might be thinking. And it's not just, slick hedge funds with 12 different monitors. It's also more conservative funds like state employee retirement funds. In fact, like the state employee retirement fund in California has $440 billion under management. And then the Norway government pension fund, that's the largest one on planet Earth, I think, it has $1.3 trillion under management. So even if they do an incremental move and move a tiny piece of their stuff, you're talking about billions of dollars moving. And there's a pension fund in every state, every region, every nation in the world. And there's also college endowments, quite big. Harvard has 50 billion, and then Stanford and MIT and the University of Texas all have multiple billions, north of about 30 billion each, I think. And universities all around the world have the same thing. So all of it adds up, and when they all have mandates, they're all required by their mandates to make conservative, methodical moves, and they all listen to the news, and they all move based on it. And a lot of times they'll move in unison. Now, how do they move? This is what I talk about: hawkish, dovish, hawkish, dovish, dovish, hawkish. The reason we talk about it, you've heard of bulls and bears, but I would start by explaining a few terms, and then all the concepts are up front, and then everything in terms of results is in the back part. But hawkish and dovish. Hawkish means leaning towards interest rate increases, and so it also means leaning towards short-term currency strength or medium-term currency strength. And in price action terms, that means heading towards the currency. Simple as that. And dovish is just the opposite. It means leaning towards rate decreases. So it means taking a medium-term accommodative stance is what I call it. Not so much weakness, but just agreeing to take a less aggressive position versus the other currency. And simply put, in price action terms, it means it's moving away from the currency. And this is just a good metaphor to use because in stock land, there's bullish and bearish, it's up and down. But in the stock is always the top of the chart. More expensive is the top and less expensive at the bottom. But in the Forex world, the dollar can be on the numerator side or it can be on the denominator side. Any currency can be top or bottom. So the idea of like bullish and bearish kind of lose their meaning a bit because just looking at two different charts of the dollar, we've had this before. On one chart, it'll go up because the dollar is a numerator. On the other, it'll go down because the dollar is a denominator. Solve that problem elegantly by just saying, if it's hawkish towards a currency, it's going towards that currency. If it's dovish, it means it's heading away from that currency. So you can say hawkish towards the dollar. That means on every chart going towards the dollar. If you say dovish away from the euro, it means on every chart it's going away from the euro. So that is the reason we say. Also, the bullish and bearish are more stock terms, and it hovers on the fact that with stock, they say it takes the stairs up and the elevator down, which means it moves differently if it's going up or down. But Forex not like that. Forex it's more zero gravity, where it can move up or down equally. And you'll see the same pattern. This is something we'll talk about. The same pattern can happen right side up or upside down perfectly equally easily. And you just follow it with the long or the short button, just exactly the same. With that, more metaphors. When we talk about a whipsaw, this is a whipsaw. It's like a giant two-man saw they use in like old-timey lumber camps, where one person pulls it one way, the other person pulls it the other way. And one person goes this way, and the other way. So it's back and forth and back and forth. It can go back and forth as multiple times. In this case, we'll talk about whipsaws usually happen where it fakes to one side and then zooms to the other side. Like, tell me if you can see this well enough on your screen with the Japan rate. Can you see that?
Yeah, we can see it.
Okay, perfect. Because I can zoom in, I think. But what I want to show is that this Japan rate actually whipsawed on this. If you can see twice for 40 pips down here. Boop. This whipsaw, that whipsaw. Those are 40 pip whipsaws, and then it just shot up instantly, and it continued for 200 pips thereafter. It just never came back. Even on the next day, it just kept on going. That's what I mean when I say, in this case, whipsaw. It's not so much a range; it's more that it just shoots in a fake out direction, and then with equal vigor, it just sort of rubber bands in the opposite direction and shoots. We talk about it when, if the news comes out a certain direction, there's an appropriate direction that it ought to go. Whipsawing means it goes in the other direction as a fake out, and then it goes in the correct direction, and then it just continues to shoot. That is what that means. Next, dead cat bounce is something to hear about, and you see cartoons online. I didn't want to show you the cartoons of cats getting splattered, but what it means, it's a 1920s sort of metaphor where they say even a dead cat will bounce. So if a cat is falling off of a building, or if it hits the pavement, or if it hits something along the way, it may be dead. It's destined to fall all the way, but it bounces in a way that can fake you out. I call it just the bounce, or the cartoon cat bounce. So we're not. It can be a cartoon cat. He's not getting hurt. He'll be fine by the next episode, and he's got 9 lives anyway. And this is what that looks like. Okay. This is the American GDP. You can see that it falls a good 50 pips or more, and then it has a bounce in the middle, but it's destined to fall another 50. So this is something to be careful of, because if it falls, and in that 10 minutes you think, oh, it's destined to go up again, be careful, because it can have another drop. And this is why I dedicate a lot of energy to figuring out the correlation between how much of a hawkish or dovish surprise the news was versus how far would you expect it to go so that you don't get tricked if it stalls or it stutters, but it's destined to go much further. That came into play this morning, actually, because, okay, I missed the CPI because I was preparing, but kind of mad I did because it would have been really profitable. And when I look back, I was kind of stunned because I looked on my chart to see that even on a dovish offset of 0.1%, that sounds small, that you'd expect to make it move 100 pips to the long side on the Eurodollar chart, and it did 110, and it actually moved, I think, 112. So it was almost perfectly dead on accurate, judging how far it would be expected to move with that level of dovish surprise. And I'll explain that a little bit more as I go. So that's a bounce. You can see it, and then it hits midpoint and it bounces, and then it goes down, and then it bounces again and again and again and again. So if you're trying to take this, there you go. You're trying to take this north, you might have some difficulty with. Thanks. Okay, and it can happen upside down and right side up pretty easily. This is the same exact concept, but you see it's shooting upward, and then the little bounces are downward. So imagine it shooting up, and then it bounces down a bit, and it shoots up some more. It bounces down a bit, shoots up some more, several more times, down a bit, shoots up some more, and it just never looks back. It bounces 1, 2, 3, 4, 5, 6, 7, 8 times before it finally tops out. So it goes to show the pattern always in Forex. It can happen upside down or right side up, exactly the same way. And here we go. This is jolts. This has 1, 2, 3, 4, 5 bounces. And another thing you notice, it can sometimes look like a little bit of a lightning bolt. I've actually heard this called like the lightning bolt pattern or different kinds of names, because it goes a direction and it zigzags a bit and then it keeps going with sort of like a, if you're going to draw a cartoon lightning bolt, or sometimes they call it the Harry Potter pattern because it looks like the lightning bolt scar on Harry Potter's forehead. And sometimes it has like 3 or 4 or 5 zigzags. It was like a giant lightning bolt. Let's see, here's the FOMC. It goes 1, 2, 3 times in a bounce, and then it comes back, but then it continues the very next day. This shows that the bounce, the continuation, it can go, especially with the FOMC, it can go into the next day. This FOMC happens at 2. It goes on until the break at 5 Eastern, and then it just continues into the Asian session, into the European session, further and further and further. So this is something to watch out for when you are doing those reversals, because it can go and it can just not stop until the day after tomorrow on big news events like FOMC especially. In fact, I was saying in the beginning that every single time I got 5'd out, that I got shut out, it was right around the news. In fact, it was always right around the FOMC, because I always avoided FOMC Wednesday, but it was always the Tuesday before it or the Thursday after it, or sometimes the Monday or Friday that precedes or follows. In as much as like FOMC, it's always on a Wednesday, and it just sort of like has an aura of effect that expands out to the entire week, that entire week from Monday to Friday. And it happens every 6 weeks. So it's a little hard to avoid it sometimes. And these events, you see it on the calendar, they pop up every 3 days, every 2 days. Avoiding them can be tricky, and you don't have to like shut down and not trade for like half of the days. So that's why I decided to just attack them, confront them, find out what makes them tick, because they pop up often enough. And last one, wait, this is CPI. This one to show that you can have a nice straight shot and it doesn't have a bounce in it until it hits the top. But even with a huge 100 pip move like that on the initial drive, sometimes it's just not coming back. If it's definitive news, it's just as though the invisible hand of the market has pushed the appropriate price up 100 pips, 110, 115 pips. And you may expect it to come back down thinking, oh, it's a giant bar. But when it's news, it's different. It can be a giant bar, 100 pips tall in 1 minute. But if the news is definitive, if the news has impact and it's sticky, just imagine that like before the CPI popped, this is maybe like a couple months ago in April, the price agreement was at that lower level, but as soon as it popped and that new information was known in the world, it's as though the appropriate price is like pushed by the giant invisible hand of the market up 100 pips. And then it's just going to do price discovery up in that range until it finally finds what the market's going to agree upon. So don't always expect it to come back. It may not. Another concept I want to talk about, and this is something that is good. In keeping with the zero gravity idea, these are continuation patterns versus reversal patterns, something I kind of talk about a lot. Anyway, extenuation pattern simply means that it goes, it pulls back a bit, but is destined to keep going. And you can see on the left two sides that can happen right side up or upside down. And a spike pattern, similar, but it shoots up almost vertically. And then it kind of comes down, in most cases, like a little bit of like a Nike swoosh is the way I always kind of saw it. So you can see vertical, tops out at a certain point, and Nike swoosh looks like it's going to come back. But in most cases, as we'll see, it really wants to swing up and continue in the same continued direction as the initial spike. And that pattern can happen right side up. It can happen upside down.
That's cool.
Yeah. And a reversal pattern. If I say reversal pattern, so it means it's reverting to the mean. That can be a big swing back, or that can be a range where it's a series of reversals that happen a little bit like a sine wave, like a pattern that you see on the right. That is something, okay, that we're all familiar with, but it goes a little deeper than that. If you need, I can stop and do questions here, or do you want me to push onward?
Yeah, we could definitely open it up if anybody have any questions or thoughts.
Better ask, because otherwise we're going to get into R squared regression.
I have a question.
You,
What is
you
that?
back up?
Just
Okay,
kidding.
good.
No,
Go ahead.
It's like, you better ask questions now because you're gonna get lost in the next slide. You're not gonna know what the heck's going on.
The difficulty curve has some sharp angles in it here.
So overall, I
yeah.
think overall the question that I have
Mhm.
is for you, Doug, really.
Sure. Yeah.
How long did it take you to amass the knowledge that you have now? And why did you decide to go on that journey? Like, how does that help you to become a better trader? Do you know what I mean? Just help us.
This project, I started on around Christmas when it was on Christmas break.
Okay.
And I did it because we were in your class and you gave us homework to backtest a high probability pattern.
Okay.
And I said, what's the highest probability pattern in the world? And it needed news events. Because when you get into certain news events, we'll see in a minute, some of them are more than 80%, more than 90%. Some of them are effectively 100%. You know, they just haven't had a miss yet. Like we'll see when you get into the Switzerland rate, they just haven't had a miss yet because that's Switzerland for you. It's 100%. We'll see that in a minute. And there's two things. Like I said, the first reason is just to not get shut out by a marching market, just to not get torn apart by a CPI surprise, like, you know, an NFP data that turned into a huge run on Friday. And then just this morning, we had a soft CPI data that impacted people's outlook for rates. That started a run of 112 pips. If you're on the right side of that, you win. And if you're on the wrong side of that, you have an orange number. That's it. That's the rationale.
So that was the impetus of
on the
all
right
this,
side of
right?
it, your number is green. If you're on the wrong side of it, your number is orange. So there are ways to see that it's coming. There are ways to sense it. There are ways to know when it tends to happen. And I mean, well, on the simplest of the solution is easy. You just start pressing the opposite button. I always like to say the button you should be pressing is only 2 inches away.
What? I don't.
If you're pressing the sell button, the buy button, only 2 inches away.
It's only
If
2
you're
inches
pressing
away.
the buy button, then the sell
It's
button
only
is only 2 inches the other way. So that's my little cutesy-ism.
What about the X? How far is the X?
Yeah, that's all the way there. That's like 14 inches away.
Don't press that.
That way it's like all the way over.
I'm just kidding.
No, it's true. So if you're on the wrong side of it, just what I tell myself in mind is that the button you should be pressing right now is only 2 inches away.
It's only 2 inches away. I love
So if
that.
you're pressing the short button and you should be pressing the long button, then it's right there.
I
So
love it.
um
Jason asked the question, are you
Go
going
ahead,
to
yeah.
explain, are you going to explain how to trade a marching market?
yes.
Okay, so that's going to come up,
oh,
but we
and-
don't need to go into that unless you.
If you recognize the marching market, it's a continuation pattern. If it really just wants to go north, or if everything calculates that it wants to go long, you wait for a pullback and you press the long button. I mean, you can also look at how deeply it reverts, and that's why you see the double line there where it's 5. That's the golden ratio. It's 61.8%. Some people swear by it, but really what it comes down to is if it's a deep pullback, it can have the tendency to come all the way back. If it's shallower than that, it has a tendency to keep on going. But what becomes more important in that moment is what was the news? What was the expectation? What was the outcome? How much of a surprise was it? Hawkish or dovish? That tells you how far it's going to want to go on average.
Gotcha.
But yeah, to do a pattern that wants to go north, just you lean on that long button. You ride the wave. Yes, no, yeah.
Instead of what
Yes.
you taught me is you don't want to whip the wave, right?
Yeah, you don't whip the wave. You gotta ride the wave.
You want to ride it. Don't try to fight it.
Yeah.
Ride it. Don't fight it.
All right. There are patterns to it. I will get into that, but it would take a while. I'll get into as much as I can, and that'll be more in the back half. Okay. Ranges. R squared. Do we have any more questions? Because I love questions. You can hit me with as much as you like.
Sounds good. If anybody puts them in chat, I'll yell at
Otherwise,
them.
you're getting a statistics lecture right now.
Okay. So,
Okay. R squared. This is good. R squared regression is important because it's one of the most basic methods in stats for searching for correlations. And this is what quant funds do, quantitative funds. This one I'm throwing at you, it's just the first example that I grabbed on top of the Wikipedia page for R squared. And you'll notice the first example they use is from the world of finance. Because when you take a stats class like this, they start by talking about, predicting the weather or stuff like that, or, heights or weights or, weight tables or something. Someone always raises their hand and says, like, can you apply this to the financial markets to make tons of money? And the answer is, yes, you can. Actually, there's always a chapter in that book that talks specifically about financial markets. And the first thing they kind of get into is, how do you look for correlations? How do you test to make sure that they're real? How do you test to make sure that you're not just being fooled by randomness, as we talked about? How do you make sure they're reliable? How do you make sure that you could have confidence in them? How do you quantify how much confidence you should have that a pattern will hold, that a correlation will apply, and that the number you expect will be as close as possible to what was projected? But that means how much predictive power does it have is what I mean, is what I want to talk about. So okay, R squared. There's R squared, there's rho squared, there's chi squared. It's called the coefficient of determination because it tells you if you know one piece of data, can you determine the other piece of data from it? Or can you predict? That's the question is, can you predict one thing from another? And what you're looking at, you look at the tilt of the line. That's how you quantify your edge, how much predictive power it has. And when I say edge, I mean literally like the most strict definition of the word edge in trading is that your method has real predictive power. And in fact, that's the exact phrase that statisticians will use. They call it, how much predictive power does it have? And they quantify that. That's what they do all day, so how they keep themselves entertained. And you're also looking for the tightness of the dots around the trend. And that's how you quantify how confident you can be that your projection is accurate. Or if it's fuzzy, very simple. If you're trading, just make your target a little bit tighter, a little bit closer, and it's easier to hit. If you think it's going to go 100 pips, then if it goes 50 or 60, say that's good enough for me, and press the close button and take your winnings. And hopefully that's good enough. Yeah, So when you look at this, you really want to see that the trend line there, and this is something you can do easily in Excel. Whoever did this, looks like Excel. Yeah, I do it in Excel myself. You can do it with a couple clicks of the mouse. It seems complex, but it's delightfully simple. Excel does it for you. Excel does the math for you. Excel does the chart for you. Excel does the line for you, and it gives you the equation of the trend. And it tells you what your confidence interval is. So it's just, there's no thinking really. You want to have the line be at an angle. If it's flat, it's not helping you, except to tell you that there's no predictive power there. If it's angling either to the left or to the right, that's equally good, because it just tells you there's a positive correlation or negative correlation. Either way works fine, because if it correlates to going long, you can just press the long button, and if it correlates to going south, then you press the short button. We have, we got a button to go up and we have a button to go down. So if that line slopes up or down, it's perfectly equally good. And then the tightness of the dots, that's how you quantify confidence, like how much of a risk you want to take that this prediction is hopefully close to being accurate. And they call that the confidence interval or the confidence threshold. And if you like, you can use that to determine how much risk you want to lay down, if that makes sense. And it looks like this one, yeah, this is the first example they gave online. This is the way I do it. You can see nice slope there, a slope down, there, a slope up. Either way works pretty equally good. And I'll tell you the secret. The reason this one goes down, this one goes up, is because this is the pound. You do it on the GBP USD chart. The pound is on top of the chart, so the line goes up. Here, you're doing the dollar's on the bottom of the chart, so the line goes down. Either way is perfectly fine. What you really want is a nice slope to it, and you want the lines to be as close as possible to that line. In fact, here we go. This is the CPI. This is the US core CPI we did just this morning. And if you can see where our cursor is, this is the dot from this morning that is put on there. And it called the follow through to 112 pips long. And I think that's exactly about how far it went, give or take. You can double check. So I was delighted to see that it works. Okay. I thought about this because it amused me. A lot of people say when people say overanalyzing, what they really mean is you're hesitating. But the golden trick is to be able to do this in a mathematical model that's on a computer, so that if you want to analyze, you can do terabytes and terabytes of analysis. But if it happens in a second, and then you can see what your target number is, see what your confidence interval is, see what your expected distance is, know your direction, know your vector, and know what your approximately how much you could risk to put down on it, or how confident you should be it's going to hit. Then if you can have the computer do all that math for you in a couple of seconds, in less than a second, then you can't really accuse someone of overanalyzing at all. It's, well, because you're not hesitating at all. You have the computer do the analysis, and then you're ready to press a button within 5 seconds. And it does move fast on the lightning round, so you have to be ready within a few seconds. The straddle will get you in, and it's a pending order, and then within a 5 or 10 or 15 seconds, you need to be ready to decide if you want to bail out or not, or if you want to let it ride. It's fun, it's fast, and if you're the kind of person who likes to move the needle, it is essentially the fastest setup you can possibly do. It is, you'll see, possible to get 2, 3, 4% in less than 2 minutes. Sometimes even a little bit faster than that, depending. With straddles, it's a method that it thrives upon volatility and extreme conditions. So that's why I say, God, I wish I could just go back in time like a year, not even taking any future information, but just doing this method a year ago was, in some cases, like so fast and extreme, you could have popped multiple percent in just minutes. But never fear, it's actually when I'm looking at it, it continues to be very reliable. I was worried that it would like fade, maybe one of those like things where it works in some conditions and it fades in others, but as we'll see, it has remarkable staying power. The moves aren't as big, but they're more reliable in these months now, and it's overall in terms of profitability and reliability, surprisingly, we'll see, remarkably, it has continuity, it still works. And add to that, within 6 months or 9 months, we're going to be getting back into a rate lowering environment, which means they'll be playing the exact same game of, well, will they, won't they, will they, won't they? But instead of wondering, will they raise rates or keep them steady, they'll be playing the game of, will they lower rates or keep them steady? It'll be almost the same exact level of fun. I hope. We shall see.
So what you're saying is, if I surmise this, basically you're saying for the news event of CPI, you want to use the news straddle.
Yeah, it moves so quickly. You can't, when it pops, it pops. You can't press the button fast enough. You can't do the math fast enough. You can't type in the number into the chart fast enough to be able to catch it, because it moves in just a second of the news announcement. And you have to have pending set up if you want to do the lightning round. There's the lightning round, there's the cool down phase, and there's the follow through. First is fastest, second one's a little bit more relaxed, and the third one is just normal, relaxed, easy scalping that can go for an hour and a half.
Yeah, and according to your
with a definitive direction signal and a definitive target and estimated target and estimated endpoint in time, so you know how far it ought to go and how long it ought to take, so you know when to quit and take your money and head on down to the Lamborghini.
Hey Doug, I was just curious, is this a chart that you've come up with, just basically taking the information and putting this in a chart yourself, or where are you this chart from?
This is mine. Yeah,
you just take that info and get it from there.
Oh yeah, I get it all off Forex Factory, really. And then I just type in the expected, well, expected and the outcome. That's what determines how much of a hawkish or dovish surprise it is. And then that's what's going across. And then up or down is just how many pips it's moving, long or short.
Yeah, I was having some microphone issues earlier. I was trying to ask you earlier, you had the data for the jolts and the CPI. Was that just the recent ones? Because you had shown the chart and how it jumped. Was that just, when was that? Was that just the recent one that just came out?
Oh yeah. I have data going back 18 months.
Right, but the chart you shown, was that the one that just came out recently?
It is.
Yeah.
From this morning. That's this dot here, if you can see where I'm.
Right.
This one right there, the top.
Yeah, that's great. I was just curious, do you follow the Treasury, internal cap flow, or the Supervision Regulatory Board of Directors dot plot or Fed Watch tool?
I do look at the dot plot. I do. I don't have any special method for it, but I look at it. I appreciate it. Usually, the squawk tells me how the dot.
I think this is great, Doug. I've really, I've been a very positive, I've always followed the news and kind of had some backlash from, the Apiary Fund, but I'm right on board with you with the news, because it does make a difference. But the bottom line is the people really need to read the board of directors in the banks, because that really tells what's really going on. So anyway, I'll follow up more with you later. I love what you're doing. I'll let you go.
Cool. Yeah, you got to pay attention to it, because it's gonna come and get you. It's gonna move the market 100 pips. And if you're on the orange side of that, then you're looking at 100 pips of drawdown. If you're on the green side of that, then you're looking at 100 pips of.
I'd love to have a side conversation with you, but go ahead.
Sure. Yeah. Hey. So good. Thanks for asking. What does this mean? Okay. So here's the origin point. The news this morning was just a dovish outcome of just 0.1%, which sounds small. It's fairly small. That would put it over here. And based on the trend line from the last 18 or 19 points of data, it expects and projects that it would move long about 100 pips, and I think that's exactly what it did. Okay, that's it. Oh, and you can see at the bottom, the tab that's active is for core CPI, and all these over here. I kind of went nuts and did, I think, 19 or 20 different events. I did all the GDPs. I did all the red icon events because I just had to know how they all kind of played out.
Have you noticed in your in back testing,
Mhm.
does it matter on seasonality at all?
Not so much seasonality. It's more like the regime of what's generally happening in the financial world.
Sure.
So what affects it more is, like if you go back into the COVID times, it would all just be about
Right.
the shock of COVID and the shock to the
Right.
employment.
I was just wondering if like quarters made a difference, like Q1, Q4, stuff like
Not
that.
so much, no. Not seasonality through the year, like Santa Claus kind
Right.
of rallies, no. But more about what's happening during that. Like if it's during the pandemic, it's going to be about the shock to the employment numbers in the stock market.
Right.
If it's
Bottom
if it's
line is what's
post-COVID,
happening with the banks. Bottom line is
Yeah.
what's happening with the
yeah,
banks.
yeah,
And
that's
You
it.
can do seasonality all you want, but I'm telling you what, I've seen seasonality. It's all about the banks and what's going on with what they
100%.
want to do.
It's just why I showed pictures of the 4 central banks right from the start,
Yep.
with their
Yeah.
giant round tables
Yep.
and their screens and their maps and their water bottles. Do you remember
Yep.
that? Okay.
I've
That
watched-
those are the, that
Yep.
a lot of it really just comes down to interest rates. Sean will tell you that on the beeline when you're in Gold 2, there's a module where he gives the introduction to like the macro stuff, and he the first thing he says is that it really all just comes down to interest rates,
Mm.
and it does. And oh, the other thing he said that was really brilliant, I thought I shared this with you, was that when he was giving us a little talk, he said the reason that the central banks want to control inflation is because inflation destroys civilizations. Like inflation is what tore the Weimar Republic of Germany apart in the 1930s. And inflation is what happened to Venezuela and Zimbabwe and now Turkey and whoever else, Russia, essentially. Inflation can destroy economies, and inflation can destroy civilizations, and that's why the metaphor is to treat it like a war against the beast of inflation, and to like the metaphor of hawkishness is obviously a metaphor to just vigorously attack and stamp down inflation, because it's so important to quash that and quell that it's worth slowing down the economy, it's worth slowing down business borrowing, it's worth slowing down everything else in order to just stop, focus, and quell inflation. And that's exactly what that's exactly what the central banks do. That's their entire job, their entire mandate in most cases. America, the FOMC, they look at unemployment and inflation, but all the other central banks of the world, they just look at inflation. That's their only mandate. That's their one job, is to control inflation.
And their tool is the interest rates. Have you ever read Mark
Yeah.
Mobius' Inflation Myth?
I haven't.
Check that out, man. It's
Okay.
going on right now.
There you go.
And Doug, I just really quick, is there, and you may have gone over this, but is there any specific area or website where you found that you can collect the best data for your for creating these charts?
Wonderful question. I get it from I get the basic numbers from Forex Factory, because they have expected numbers and of course the outcome numbers. It's interesting. The expected numbers, that's Forex Factory's own kind of personal. There's several different data providers. Some are free, it's like Forex Factory. Some of them they charge you money and they claim to be a little bit better, a little more accurate. The cool thing is that if I can get my hands on data from other, I can actually put them in the chart, test them for real, and see, are they more accurate, yes or no? Because they're going to say they're more accurate and charge you money, but if I can get my hands on that, like is it more accurate? I can tell you yes or no just by punching into the chart and seeing, simply put, does the R squared number go up or does it go down? If it goes up, it's more accurate. If it goes down, less accurate.
Nice. And have you kind of noticed,
I've noticed
real difference between the paid and not?
Forex Factory's data is so close to being accurate. I haven't even thought of, paying money to get any other kind of data.
Right.
It's extremely, especially for interest rates, because they have to, in most cases, go up or down a quarter point. So it's almost always correct.
Hmm.
And for other,
yeah.
they can go in any kind of decimal range. I find Forex Factory is so accurate that I don't feel like I feel like I'm totally cool to use their data.
Nice.
Yeah.
Yeah, no, that's good to know for sure.
Cool. Where was I? Let me rock on, because we might have to chop this in half and like bookmark it. But over analysis. When people say over analyzing, what they mean is the goal is to set it up on the computer so the computer does the analysis. As soon as you punch in the outcome number, I listen to a squawk, so here on the squawk, I'll punch it in. That shows me where it is left to right on the x-axis. I look and see where the y-axis would fall with a dotted blue line. There's my target. It hopefully, and I can see by the R value how confident I ought to be, or I can estimate with the height how much the little diamond, the blue diamonds vary from the trend line, gives me an indication of how much wiggle room I should leave. Like if expected target 80 pips, I might say if it goes to 50, I'll just take that. Easy as that.
So it sounds like it really does help kind of give that confidence. Right?
Oh, it's nice. Yeah. Oh, confidence supreme. I feel like I lean too much on it sometimes. But it's good to have. It's good to have like just a direction and a vector and a target and a confidence level. And then after that, you just look at the price action, because it starts to bounce within the candle. And it can kind of trick you. But I found that the best way to do it is to mostly trust the number. And if it goes at least 2/3 the way to the number, then go and take it. Don't let bouncing scare you out, because it's always going to bounce within the candle. So yeah, it's good to have. It builds supreme confidence, and then you come back to the chart and you're looking down the barrel of price action, just like always. And it's actually kind of fun. It's actually I don't know, it adds a degree of fun to it and certainty to it that that's kind of neat. And I'll show. So oh, this is what I'm going to say. So the real trick is to be set up to do all the analysis in seconds. Have the computer do it for you, so that within just 5 seconds of the pop, you can be ready to start pressing some buttons. And this is interesting. In hedge funds, I've kind of looked into this. The fundamental analyst and the trader are two separate people. One person will do the fundamental analysis, and another person will be the trader, the person who executes. And it's usually two separate people, but the fundamental analyst usually gets paid like 120, 150,000, pretty solid. But a successful trader gets paid 300, 400, 500,000. So the trader actually gets paid more than twice what the analyst does. But what if you could do both? What if you could wear both hats and be the financial analyst for 5 seconds and then be the trader for 90 minutes?
Right. That's cool.
That's my vision. If you if that makes any sense.
Yeah, no, it definitely does.
So predictive statistics. It sounds kind of fancy, but it really just it's how you use charts and numbers to predict what's going to happen in the very near future. It's really the most basic kind of plain vanilla way that people do things like weather prediction. Prediction. We say you can't predict, but when you look at the weather report for later in the afternoon or later in the evening, if you're just looking out a few hours into the future, it becomes extremely accurate. Like the weather report for later in the afternoon or the weather report for the evening is 80 to 90% accurate. But then if you try to look forward 3, 4, 5 days or a week, then it instantly falls off a cliff, because when you start looking more than a few days in advance, there's just way too many factors that can happen, way too many atmospheric things that can happen between now and then. So if you're trying to make a super short-term prediction, you can get to 80, 90% accurate. If you want to try to look out, more than 4 or 5 days, then it becomes much more of a guessing game and much harder to get an accurate prediction on it. But yeah, check it out. I mean, next time you're going on a picnic, keep track of how often the weather report for this afternoon is accurate. And that's really what we're doing, because we open and close before the end of the day. We're really just trying to figure out what it's going to do in the next 30 minutes, 60 minutes, 90 minutes.
Yeah.
Super short-term prediction. Keep it tight.
You can kind of use those for your, as one of your, 1, 2, 3s, right? One of your threes, more evident, right?
Oh yeah. So good stats. So hey, so like I said, this is the way that quant funds approach it. And I'll do a Q&A in a second, because I feel like I've dropped a lot on you here. The way quant funds approach it is they look for all possible correlations. They test them to see, do they have predictive power? Are they real? Are they reliable? So you're not just being like fooled by randomness, like the Nassim Taleb book we were talking about just earlier. So you're not being tricked by randomness. You're not being fooled by something that happened a couple times recently. You're really doing a look back and saying, is this real? And does this have longevity? Is it reliable? And then you get into, is it tradable? Can you actually trade it and not get, mangled by bad fills or slippage or spreads that get super wide? And then, is it profitable? So that's it. That is what quant funds do all day.
and definitely appreciate you sharing that, and again, bringing. I know you put a lot of time right into it for this. So
thanks. Yeah. Let me stop and do if anyone has any real questions, I can stop again here.
Yeah.
But only if it's a real question.
Seminar, you got the stats. From here on, it's all just alveo.
Yeah,
The rest of it is all the alveo charts.
I think
familiar.
it was Josh that kind of asked, but so you analyze this before you're trading, also during, or kind of walk us through that process.
If there's a news event set, to update the chart, it takes about 10 minutes per week. Like literally, I do it at the end of the week, and it's literally just punching a few numbers in. I do it on M25 because I can scroll back as far as I want to go, and if I put notes on it, they stay there, they don't disappear. I just measure how far up, how far down, how far continue, and then I punch that in, and then it puts it on the chart.
Hey, Doug, I was
It
curious.
takes about 10 minutes per week to update, and then if there's an event happening, I'll look at it, and it takes about 2 minutes to kind of get in my mind what's the expectation, and when it pops, I type it in, and it takes about 10 seconds to see where the expected line is, and then at that point, the straddle has already gotten me in, and it's a matter of deciding if I want to let it run or bail out.
Hey, Doug, you have mentioned definitive news. What do you determine as definitive news?
Okay, you can quantify that too, actually. The definitive ones are rate increases for all the countries, not just America, but America, the EU, Canada, Switzerland, Britain. Even Australia, New Zealand, and Japan as well. The big ones are rate increases, then inflation reports, and for America, also employment like NFPs, but also JOLTS. Compared to that, other ones like sentiment or productivity like GDP, less important. Those will be good because they'll give you when they pop, they'll give you a hint on direction that's usually correct, and it's nice to use, but you won't see like fireworks. It'll just be sort of it'd be something to start a trend, because the people at the institutions at the desks, their job is to be there at the desks. They're kind of required in most cases to kind of sit there for all day, and they are alerted if there's news, and they use that as a entry signal, and that's what starts the trend. Is when they put there are billions of dollars behind it. That is what starts the trend, and that's what creates the continuation.
Yeah,
Um,
I agree with you with the interest rates, and I think that's why the jolts and all the other numbers had such a big pop this time.
Mhm.
But if you didn't follow what was going on with the banks, I
Mhm.
don't think it would have popped as big as it did. So
Mhm.
bottom line is, I agree with you. It's the banks, and then everything else follows after that.
Yeah.
Just curious what you thought. Thank you.
Oh yeah. You can get surprised because I looked at it and I thought, oh, it's just 0.1% difference. Golly gee, and then later on, because I wasn't trading on it, so I didn't think too much about it. I was making slides, and I looked on the chart and I was like, wow, yeah, that predicts 100 pip move to the long side, and I thought, well, that's what it did.
Yeah.
That's like just that 0.1% seems so tiny, but just that can move
Yeah.
at 100 pips. And
Yeah,
100
I'd love to
pips
have
is
this
enough
side
to
conversation.
like
Yep,
make your day
you got
more
it.
vivid.
Yeah. Yep, I agree.
It's very cool. I think that, of course, just using both, right? Your technical analysis, and then having a better idea of those fundamentals. I just know for me, it's ever since kind of we've been talking about it, and actually almost from day one, really opened up my eyes that I need to get more data, right? Track that data, and it allows me to have to make those better decisions.
Yeah.
And it's
Yeah.
really worked out well. Yeah, I really enjoyed it. Yeah.
It's actually not too hard. I thought I'm making it way too complex because I'm an ultra nerd. I'm making it way too complex. It really is such a simple thing as you look at Forex Factory, the number is red or the number is green. Number is hawkish, number is dovish. Plug it into a chart. Chart gives you estimation gives you definitively which way it ought to move by just macroeconomics. Line go up, line go down. How far? How long does it take? Done. And then the next however long is just seeing if it actually kind of gets into that target or not. That makes sense, yeah. But yeah, red number, green number, pocket, dovish, line go up, line go down. I hope that made it. Am I made too complex now? Okay.
And Josh made a pretty good question. Maybe even doing a class on the spreadsheet, right?
Yeah, you could. Yeah, possible. Very possible.
And are you
do it right now
to share the sheet spreadsheet?
Yeah.
Nice.
Yeah, I'll give it out. I'll give the sheet out, in fact, because I actually want people to kind of poke at it if they're serious and they want to look at it, because I'm sure you can see something in it that I haven't seen quite yet. I know I'll get into this. You can easily change the graphs to compare any two columns you want. Just, is there a pattern there or is there not? So splendid example, because we were talking about, is there a pattern between the direction it goes before the news versus when it pops? Because we were wondering, like, oh, do the big boys have some sort of secret inside information? Do they, do they get a leak? Do they get inside information? And the answer is no. It's exactly 50-50, or it's so within a margin of error. The correlation at all between what it does beforehand versus how it pops up or down is exactly like a coin flip. So they don't have any inside information at all, if that's is what that says. And indeed, the SEC watches them to make sure they're not. The SEC sees that they're entering in quickly or beforehand, and then they're correct too often. I mean, they'll be suspected of having inside information, and they'll get audited. So maybe that's the reason why it's just perfectly like flat 50-50. Like it looks like Libra, like a double pin balance of perfect 50-50 balance, long and short.
The balance.
So hey, so now we're on the chart. Okay, this is the pattern. This is the NFPs from just last Friday, a couple days back. When I say perfect, it's because it shows the opening drive. You can see it in green there. Nice green line there. Opening drive is the news direction. Sometimes it happens seemingly upside down, but like if it goes like this, 48 pips, then then that's the direction it's going. That's the direction the institutions want to take it. They have the billions of dollars. If they want to take it north, then it's going north. Right? Maybe that's a cutesyism, but like if the institutions have their billions and they definitively want to take it long or they definitively want to take it short, then that's a signal. Especially if it seems like it's minor news, but a huge reaction. It shows that they're really excited about whatever is happening right now in financial times, and they're going to move with it. And you can see there's the opening drive. It moves about 48 or 50 pips. There's a cool down phase that lasts about 20 minutes there. And then the follow through is when the more, okay, when the news pops, the opening drive is when there's a lightning round with a flurry of algorithms and bots and institutions that have fiber optic cables that connect directly to the New York Stock Exchange or the liquidity provider, so they can just get in there instantly with fiber optic light speed, and then boom, there's a movement, there's a lightning round. That goes for about 8 or 10 minutes. Sometimes 2 minutes, 8 minutes, 10 minutes. And there's a cool down phase, which is usually about 20 or 25 minutes. You can see that. And then after that, the more conservative institutions, like the ones that are like I mentioned before, the retirement funds, obviously, they're required to be more conservative. They can't just, boom, boom, like shoot billions of dollars out of a bazooka at some hot shot move that's happening in a bazillionth of a second, because they can't lose the retirement fund for all the policemen and firefighters and school teachers of the state of California, whatever. They can't just, they're not allowed to lose 5% in one day. They're not allowed to lose 1% in one day. Like they have to make careful moves, conservative moves, incremental moves.
Yeah.
That's why there's the opening drive, then there's the cool down. The follow through phase is when all the institutions of the world that are required to be more conservative about it enter in after the fact, about 20 or 30 minutes later, after they've looked at it, discussed it. They all sit around the table, big mahogany table, I like to imagine. They say, okay, excellent, excellent, excellent. So we see the numbers. They have a meeting that's scheduled for when the news pops. And then over the next 20 minutes, they discuss it. They make sure that's right. They decide how much they want to do. They put the target numbers. And then within about 30 minutes, they say, okay, we'll move a tiny increment of our assets. But if they're $1 trillion fund, then that's multiple billions. And that's why it just starts to go, 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 go. Yeah. So that's why the follow through phase continued for 3 hours on that one. And you can see it happens on all the dollar pairs. Over to the right, those are all the other dollar pairs. Also notice, very, very simple. You can see that the euro and the pound go up. It happens to the long side. And then if you look at US Canada, US Swiss, US Japan, those are the ones where the dollar's on top and the counter currency is on the bottom. They do the exact same thing, but upside down.
Mm-hmm.
Pattern happens to the long direction with the ones where the counter currency is on top. Pattern happens upside down where the counter currency is the numerator. It's that simple right there.
Let's see.
That's the piece. And then if I can jump ahead for a second. This CPI, this is this morning. Similar thing, initial drive, 48 pips almost instantly. That is the news driver direction. 20 minutes of cool down, and then follow through phase went 80 more pips. And I think from bottom to top, that's about 110-ish. I said 108, and it went a little bit further after I took the screenshot. So that is interesting. And then over here, you can see the same thing. Pound, up, down, up. I'm sorry, euro, up, down, up. Pound, same pattern, because it's the dollar on the denominator. Yeah, US CAD, US Swiss, US Japan. Similar pattern, just downwards. Like here. Okay, Japan, down thrust, reversion and cool down, and then continuation. Swiss, down thrust, little reversion, then 3 times extension. That's something I want to look at too, is
it really looks like that
relationships. If there's a fib relationships between the reversion and the extension. Fibonacci reversion, how much is it Fibonacci extension, how much is it? Details like that. But
Right.
the main thing is, how important is the event? How definitive is the opening drive? And does the cool down period kind of want to hover, or does it seem like it's going to fall? If it's big news, if it's definitive, and if that reversion stays above 38%, then very, very high chance of continuing, which is what it did here on the NFPs there on the C.
And so, Clay had a pretty good question, and then we're kind of running
Yeah.
up on the end
Yeah.
here. But so Clint asked, how many 1 minute candles do you define as the opening drive?
However long it takes, but then it usually goes about 8 or 10 minutes. I don't define it, I just measure it.
Right.
In fact, well, holy heck. There we go. Okay. I plot it. Well, I don't plot the computer plots it. I created the chart. When you put the numbers in, the computer plots it on a real-time series, which means that if you can see like the blue, orange, yellow lines, the color represents the financial quarter. You can see the key at the bottom. How they go up, there's reversion, and in almost every single case, a very, very nice, neat continuation trajectory. I picked this up. This is Australia, and I picked it out because it's the most, how amazingly parallel and perfect all those continuation trajectories are. This is like the most consistent one. And the dotted lines, the dark purplish lines, are the averages. It basically shows of all those trajectories, the average numbers. So it's like the average, and how consistent it is in terms of the thin dotted line there is the last 18 months. Medium dotted line is the last 12 months. Thickest dotted line is the last 6 months. And I was surprised to see how close they are. Whatever because I was trying to decide what look back pattern to use. No matter what look back pattern you choose, 2 financial quarters, 4 financial quarters, 6 financial quarters, it's almost exactly the same. It's remarkably consistent for a lot of them. To go back further than that, you could, but you'd be getting back into like COVID times and pandemic times, and it would be weird, unusual, extreme data that probably wouldn't give you the best indication, because it was a different time back 2 years ago. We were more like in the COVID was still happening. We were kind of barely into the onset of the kind of post-COVID shock. You could get that data, but it wouldn't be really helpful to use it. I think 6 financial quarters is the right amount.
Nice. And, again, I really appreciate all the time, and it's just fascinating to me. And I know that a lot of our traders are taking quite a bit away, right? From this, and so they're running up a little bit late, running late for the other best. But yep.
This is here are the results.
Nice.
3 columns are for the opening drive. Right 3 columns are for the follow through phase. Some events are kind of crummy, like the Euro CPI, don't do it. ADP, don't do it. All the others, pretty good. What I'm measuring here is the chances of getting a win on the opening drive, and then the chances of getting a win on the follow through phase by doing, scalping, wobbling.
Fibbing.
On the left is a straddle. The left 3 are for straddles. The right 3 are for just wobbling on the follow through phase during the next 90 minutes after the news phase, when the news pop, and say, do you get a successful run, or does it go the wrong way on you? And for many of them, it's 100%.
That's great.
It's a very, very, very consistent pattern, for the simple reason that it rarely goes below the 0 line more than 20 pips or 25, and it almost always ends up above the zero line, measured in terms of the initial news thrust.
Nice.
You can see that here. Like simply put, lots of lines here, lots of colors here. It very rarely goes below that midline where the zero is. The orange and yellow from several months ago, and it almost always goes up in a fairly neat trajectory. It almost always ends up north of that line, and it usually ends up above the initial news spike. That's what I'm saying. Or so
Yeah.
it almost always follows generally the pattern you can see with the dotted purple lines. Not always, but quite often.
And then Ed had asked, do you have any canned parameters that you to use when you set up your strangles, your stop loss and take profit cushion?
We'll have to do that on a different day because
Yeah.
I almost had
To
a
be
hunch
continued.
that this would spill over a little bit and we'd have to chop it in different parts like the Hobbit movies or something.
Oh, you're you heard it here, guys. He's gonna do another teaching. It's only taken us 6 months to get him this one.
Oh my gosh. Okay. So I put all the important stuff up first and the rest is just LVO stuff. These are results. All right. Canada, look at all that green. America, pretty green. Australia, lots of green. That's the Kiwi, lots of green. Switzerland, wow. Go Switzerland. All green, no losses, just wins. This is how you set it up. I'll have to talk about that on a different day. You can get whipped, but if you do, you can set it up so that you have a pre-calculated finite loss. If you do a normal OCO, you can get hit by infinite loss. Leave both lines. You can calculate what your maximum loss would be. And you can see here at the bottom, I lost getting fully whipped on the last month. I lost 1.1% because I calculated I would lose about 1%. And with a little bit of spread and slippage, it was 1.1. So you can go into it without having to worry that you could get whipped, go the wrong direction, and have infinite loss. And there's other ways to do it too that we will have to come back to a different day, I suppose.
To
But
be continued.
I'm sure everybody is feeling bummed about that.
I'll zoom through these and then we're done. This is the pound. I got a bad fill. I got a little bit of orange, but I still came out profitable for the day. Australia, yeah, bad fill here too. That can happen. I took a microscopic loss of 0.13. So one whip, two bad fills. Those are the three losses at all. The rest, no trigger on this one. Tiny win, a little bit more of a win, decent win, more of a win. 0.68, 1.14. This is Switzerland. 1.14% gain in 10 seconds. Very nice. 2.06% gain in about 2 or 4 minutes. This one 2% gain in about a minute and a half. And then these are the 9 ways. If on some other day we'll reconvene, we'll talk about what are the 6 different ways to trade the news. I can go over them in more detail and what are the ways to avoid it.
We definitely would love that.
Okay.
For sure. I know.
I anticipated we would run long and that I had a lot to say. I think we'll bookmark it here. This is the last slide, in fact. We'll bookmark it here. And if we want to, if we need to, if people are interested or fascinated, we can come back to it and I'll talk about it more. And I'll be happy to do that.
Much appreciated. Definitely much appreciated. And and again, thank you so much.
Yeah, welcome. Oh, hey, Q&A time. This is the last slide.
Doug, the Q&A, when are you going to come back?
Oh my gosh. Well, I'm on.
Can't hear you, Dave.
Do I get 10 more entries if
I love it. So that's what we had. That's what we had to do.
I ran through all the this is the last slide. I ran through it super quick. This could be it, or we could
I love the
people want me to dive in more. That'd be too, but
no, I love the fact that you put a lot of time, energy, and effort into this. So I can't thank you enough for the benefit of everybody that's here.
Yeah.
I
Yeah, I do that too, yeah.
I echo the words of what Josh put in one of his chats. There's a lot of smart guy stuff here. And I appreciate you adding that and then trying to dumb it down for us people that don't get into the weeds as much as you do. But I certainly appreciate it. I love it. And I love when you guys like you and all the analytical traders out there dive into the weeds, because it helps me to become a much better trader, right? Because I'm not that analytical. I've said that from day one. So for you to do the work, it helps me to become a better trader. And I'm gonna watch this again and watch it a few times so that because I love when you're throwing out things like there's a high probability, right? So somebody also said, hey, when next time we trade the news, let's start implementing the stuff, and I love that. So appreciate it. We're really your efforts, everybody's efforts here to help the community get better, and so I appreciate you taking the time, energy, and effort of putting this together for people that are here. So thank you. We appreciate it.
Yeah, well, I did it to build my confidence and to get some wins and to make it so that the computer does the work. Computer does the work fast. Computer tells me what I ought to do in terms of direction, and then I get in there and press some buttons because I'm the trader. I'm not a financial analyst. My job is to be the trader.
Right.
And the trader gets paid more, so that's fine by me. Trader gets paid.
Trader gets paid more than
double what
the
financial
analyst.
gets paid,
Yeah,
so
exactly.
you can just kind of
So you do the work, I'll do you do all the work, and I'll make the
does the
trades.
math. Now focus on red number, green number, pocket, dovish,
There you go.
long button, short button.
And 2
How
inches
long?
from
How long?
profitability.
How far and how long?
And you're always 2 inches from profitability, right?
And you always the button you should be pressing. Only 2 inches away.
I love it.
That's it.
Thank you,
We're
Doug.
done. This is the end. This is the final slide.
This is
If
it.
people want me to more about this, I'll be glad to. Maybe we can come back to it or just you've seen it. We're done.
Sounds good. Well, thank you, Doug. Appreciate it.
Yeah.
We'll go ahead in there.
And
We'll for everybody who is in the hot seat, we will jump over to some nighttime trading. If you'd like to trade with me at night, then we'll jump over there. But other than that, thanks, Doug. And
maybe just real quick too, just to remind everybody that we are having the drawing and the raffle. So for July, for the Trade the Fund members. And then of course, every time you'll get an entry every time you post in the 1%. So once you hit 1%, of course it's one entry per day. But the big cha-ching, right, is signing up for the for this class and to teach this class. And so I'll be putting that out there. And yeah, let's get you guys a lot of entries. So let's get a lot of people teaching. So.
To wrap up, let me give credit where credit is due. This all started with I wanted to know what news events do. Sean and Todd were trading on the FOMC, with a trader on the street. And they started talking about this because I was asking them, like, well, what does the news do? What is the pattern? And Sean himself, started describing as well as he could what the overall average pattern is. And that put the idea in my mind because I thought, let's just gather data on this and just chart it. So,
Very cool.
It's not just drawn from memory, but we have it, in black and white on the screen.
Nice.
And, I think it should be good. What it gives you is it gives you a direction. It tells you if you're supposed to be going long or supposed to be going short. It tells you how extreme the news is, and it tells you approximately how far you should go and how long it will take to get there. And then you either do the pop on a straddle, or you do the reversion phase the way Dave and Sean always love to do, or you do the follow through phase with just scalp, wobble, wobble, wobble. And that's it.
Love it.
We've come to the end.
Right.
Well, again, thank you very much, Doug,
Good night.
and we will see everybody in the AM for some
Sure.
awesome
Yeah.
trading. Thank you.
Let's get it.
Okay, good night.
Thanks, everybody.
Thanks, bud.
Bye.
Bye.